Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda. As you might have guessed from the video title, we are going to have a look at bonds. A bond is a type of debt security that is issued by a government or a corporation to raise funds from investors. When you buy a bond, you are essentially loaning money to the issuer, who promises to pay you back the principal amount, being the amount you invested plus interest at a later date. Bonds typically have a fixed maturity date, which is the date when the issuer must repay the principal to the investor. The interest rate on the bond, also known as the coupon rate, is usually fixed as well, although some bonds have variable interest rates that are tied to an index or benchmark. Bonds are considered to be a relatively safe investment because they offer a predictable stream of income and are usually backed by the creditworthiness of the issuer. However, like all investments, bonds do carry some risk, including the risk that the issuer may default on the bond and fail to repay the investor. When a bond is issued, it pays a fixed rate of interest called a coupon rate until it matures. This rate is related to the current prevailing interest rates and the perceived risk of the issuer. When you sell the bond on the secondary market before it matures, the value of the bond, not the coupon, will be affected by the then current market interest rates and the length of time to maturity. Bond duration is a measure of a bond's sensitivity to changes in interest rates. It takes into account the bond's maturity, coupon rate, and yield to maturity. The higher the duration, the more sensitive the bond's price is to changes in interest rates. The process of issuing bonds involves the issuer selling bonds to investors to raise money. The issuer sets the terms of the bond, such as the coupon rate, maturity date, and face value. The bonds are then sold to investors through an underwriter or directly to institutional investors. Collateral is an asset that is pledged as security for a loan or other debt. In the case of bonds, collateral can be used to secure the bond and reduce the risk of default. The collateral can be sold to repay the bondholders if the issuer defaults on the bond. Secured bonds are backed by collateral, while unsecured bonds are not. Secured bonds are generally considered less risky than unsecured bonds because there is a tangible asset backing the bond. Government bonds are issued by governments to finance government spending. They are generally considered less risky than other types of bonds because the likelihood of a government defaulting on its debt is relatively low. Plus, if the government has run out of money, you probably have bigger things to worry about than your initial bond capital. Junk bonds, also known as high-yield bonds, are bonds that are rated below investment grade by credit rating agencies. They are considered higher risk because the issuers have a higher chance of defaulting on the bond, but in turn, usually offer a higher coupon rate. Callable bonds give the issuer the right to redeem or call the bond before its maturity date. This can be beneficial for the issuer if interest rates have fallen since the bond was issued, as they can issue new bonds at a lower interest rate. However, it can be detrimental for the bondholder if they were expecting to receive interest payments for the full term of the bond. This is just a brief introduction into bonds. There is a lot more in the world of fixed interest investing, but here is a good place to start. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.